Hey everyone, today we'll be picking strong dividend stocks on the ASX to give you a steady stream of income for every month of the year. Let's set a couple of conditions to narrow down the field. First, the dividend yield must be more than 5% so that we get a nice healthy return on our stocks. Secondly, the company must be sufficiently large enough to make the top 100 list by market cap. But we'll have a couple of exceptions in order to fill some gaps. We'll be rating the sustainability of the dividend payouts by comparing the ratio of how much the company's profits is used to pay the dividends. So the lower the ratio, the better. Keeping in mind that these do change over time. So, let's get started. In January, there are no stocks within the top 100 that pays more than 5%. So we'll need to look a little bit beyond. The three stocks that I've picked are Metcash, Shopping Centres Australia Group, and Vanguard High Yield. And though they all offer around 5% yield, each differ from each other significantly. Metcash is a food and liquor distributor that will see strong short-term gains, while SCP is a REIT that may suffer in the short term but is a good stock after the economic recovery. VHY is an ETF holding a combination of blue chip stocks that pays quarterly and everyone can do with the ETF in their portfolios. February has more choices within the top 100 with Scentre Group, Sydney Airport, GPT Group, and Stocklands, with the most sustainable dividend paying stock being GPT Group. They own and manage a strong portfolio of Australian property assets which are considered as safe as houses. The Scentre Group and Stockland are normally both strong stocks to hold but have fallen behind in dividend sustainability since the restrictions were implemented and may have reduced dividend payouts for some time. Sydney Airport is another strong dividend stock that has taken a hit and has completely cancelled its dividend for the year. It's also possible that they will offer a reduced dividend next year as well, depending on when the travel restrictions are lifted. In March, we are completely spoiled for choice of strong dividend stocks. We have Vicinity Centres, Tabcorp, AMP, Illumina, AGL Energy, Spark Infrastructure, Woodside Petroleum, BHP, CommBank, Horizon, AIG, and Origin Energy. The best of this group are the two energy providers AGL and Origin Energy, both keeping its dividend payouts well below its earnings. These are followed closely behind by CBA, Horizon, and IAG. All of these 5 stocks are excellent candidates for a March payout. One to be cautious of is AMP, which has sold its life insurance arm and is preparing for a large dividend payout in September, after which its share price will fall to align with its business. Another one to watch out for is Woodside Petroleum, which couldn't cover dividends with its profits and had to pay for its last dividend from 50% of its free cash flow. It will need to generate a much bigger earning in the future to sustain its high 6.5 dividend yield. In April, we again have a huge buffet of stocks to choose from, with Suncorp, Fortescue, Qantas, Crown, QBE, Spark New Zealand, Rio Tinto, Coca-Cola, Boral, and the second quarterly payment from our Vanguard. The most stable and sustainable dividend in this group is Fortescue, followed by Qantas and Coca-Cola Amatil, all three of which have very good dividends and earnings ratios. There's an asterisk next to Qantas though, since we all know that they will be suffering this year with the travel restrictions and might take a couple of years to return to a viable dividend stock. In May, there's a very lonely stock paying out dividends by itself, and that's Harvey Norman paying a whopping 11% dividend last year. Don't get enticed purely by the high dividend yield though, because if you look at the numbers, they are paying more in dividends than they earn in profits. And because of that, I recommend looking at a stock just outside the top 100, which is Cromwell Property Group, paying about 8% yield while still keeping the payouts lower than its earnings. June is another lonely month of payouts with only AusNet paying anything. AusNet owns the Victorian Electricity Transmission Network and is another stock that has overpaid its dividends last year. It's likely it will reduce dividend payouts this year to conserve some cash, and because of this, sometimes it may be better to not have a dividend payout for June than to risk an unsustainable stock as a long-term investor. In July, we have the 3 big banks, ANZ, Westpac and NAB, paying their dividends, as well as CIMIC and our third Vanguard payout. To be honest, I wouldn't really be going to any of these banks right now as the dividends are all going to be reduced for some time. Instead, We are going for an exception and picking Macquarie Bank instead, even if the yield's a bit lower. But its investments are global and highly diversified. It will have the bonus of some strong future growth as well, since it invests heavily in renewable energy. Finally, from August right up to December are the second dividend payouts of all the companies that we have mentioned. Let's quickly have a look at which companies are paying when. And that's all the companies paying strong dividends on the ASX that you can invest in to get a steady stream of income for every month of the year, almost like a salary. You almost certainly won't have enough funds to live off dividends instantly, but if you make regular contributions to these companies and reinvest the dividends every year, you'll end up with a staggering sum that you can retire off. If you want to see how I calculated the dividend ratios of the ASX 100 and the stocks for each month, I've left a link in the description for the Google Sheets document. If you enjoyed the video, please leave me a like as it really helps out my channel. And as always, thanks for watching, and I'll see you in the next video.